Welcome to New Zealand Property Insights. I'm Debbie Roberts, financial advisor and one of the founding owners of Property Apprentice.
And I'm Paul Roberts, Debbie's husband, and also the other founding owner. And we're back with episode 2. And we thought the start of 2026 was going to be quiet. The headlines have certainly proven us otherwise.
We've seen significant changes in the last few weeks, from new tax policies that have investors on edge to economic data that's forcing big banks to tear up their interest rate forecasts.
Today, we're going to do a deep dive into the proposed 28% capital gains tax, the reality of inflation, and why resilience is the new key word for your due diligence.
So let's dive in. So topic number 1. First topic for this one is the 2026 election and the proposed property tax. Oh, yeah. We're not going to spend all year talking about politics, though, are we?
We are in this one.
In this one, but it's going to suck the fun out of life if we keep talking about it for the whole year. So, but we're going to start with the elephant in the room. The latest election year proposal, a 28% capital gains tax aimed squarely at property investors.
So people are saying, what if we get a capital gains tax? Always at Property Apprentice, the devil is in the details. So let's break down exactly what's on the table.
So the scope is Labor's proposing a flat 28% tax on profits from selling investment property. So that's your residential properties and secondary properties. So, not your family home. Your family home and farms remain exempt. It's proposed to start on the 1st of July, 2027. It's not retrospective, meaning that you would value your property on that date and only future gains would be taxed.
This is where I have the first problem, is who's paying for all the valuations? We don't have enough valuers in New Zealand to do that on that date. Apparently, we've heard that then you would just estimate what the value was. So that's still a cost that people will have to incur. The other thing is it's not clear enough, because the capital gains tax in its current state has been brought in for one reason and one reason only, and that's to cover 3 doctor's visits for everybody in New Zealand every year. Next thing is there's not enough doctors. It's impossible. It's hard enough to get an appointment to your doctor as it is anyway. And so to do 3 doctor's visits every year for everybody in New Zealand, whether you want one or not, it just seems wrong. And it's going to cost so much money that come the July 2027, which is the valuation day, Labor have already said that they're going to start the doctor's visits from the start of 2027. So if that be the case, how are they going to fund the first 7 months of doctor's visits for everybody in New Zealand? Because that would be like 1.5 doctor's visits by that point in time, which is around, I think, $400 and something million. So it's not going to work in that first year. And then if we think about valuation day and the fact that then you have to have growth in your property before you sell it to pay tax on, that could take, it's not going to be another 6 months. It could be another year, 2 years, 3 years. So as a model and as a capital gains tax, it's flawed already. And unfortunately, yesterday, Waitangi, so this is the week of Waitangi, the Labour Party and Greens had a meeting, and they immediately said that the Green Party looking to do wealth tax and inheritance tax and looking at maybe income tax as well. And Chris Hipkins has clearly said that he's not ruling anything out. If it doesn't pay for what he needs, he will look at other options. So I think this is a big warning, because I think, yes, you've got capital gains tax in countries like the UK and Australia, but it is very, very different tax law in the UK and Australia. Their GST is not on food. It is here. Their GST is not on certain things for schools, etc., for parents that have to buy things. So we would have to actually have an entire overhauled system, tax system, to make a capital gains tax fair. I don't have a problem with that at that point, but it should be a full-blown one taken into a lowered GST on things like children's clothing for school and food and all of that, which is for everybody. And I think that then makes sense. But I think it's wrong for New Zealand would be the highest taxed country pretty much in the world if we had the current GST system and a 28% capital gains tax, because it will get expanded. And I think what people forget is everybody wants a capital gains tax
It's
on
not
one
doesn't make
condition,
sense.
that it doesn't affect you.
Yeah.
And that is the big problem, because when one comes in, which it will, it should be on everything. It should be on your home. It should be on your KiwiSaver. It should be on your Sharesies account. And it should be, right or wrong, and I think this is where people get it wrong, is once it's in, it's easy to expand. And that's the problem that we face here, is we're already highly taxed under GST system as it is. If we bring in a low level one, it will just blow up. And then those people that like it currently will hate it once it's in.
Also, when we look at Australia's capital gains tax, Australia offers a 50% capital gains tax discount for long-term holds to account for inflation. This New Zealand proposal currently has no inflation adjustment, and that inflation point is huge. If you hold a property for 10 years and the price goes up 10%, but inflation was 25% over that same time, you've actually lost 15% in real value. Yet under this proposal, you'd pay tax on that 10% nominal gain.
Yeah. And in Australia, if you buy a property to rent out and then you decide to sell it, within a 12-month period, you pay capital gains tax. It's after 12 months for every other year, so 2 years in, it's, as Debbie said, it's reduced by 50%, which is a lot fairer.
Yeah, so it's effectively a tax on your equity, not just on your profit. And the thing that really annoys me is that the way that it's been marketed is it frames investors as being speculators. But the reality is that most landlords hold their investment properties for an average of 10 years. And just so you know, most homeowners only hold their properties for an average of 7 years. Also, speculators already pay tax. If you purchase a property with the intention of selling, that triggers GST as well as tax on profit. But my advice, if you don't want to pay a capital gains tax, it's simple. Don't sell. Just make sure that whatever you invest, whatever investment you buy, make sure it makes sense as a long-term hold. And if you don't sell, you won't pay capital gains tax. Full stop.
Yeah.
If you decide that you're not going to invest in property because of a potential capital gains tax, if we get a change of government, you're doing nothing but shooting yourself in the foot and your family as well. Like, I'd rather bank 72% of the profit and pay 28% capital gains tax than not purchase and make zero profit.
Yeah. And a lot of people sort of get it wrong. They go, oh, because of that, I won't do it. And I think to put it in a different perspective, let's look at the income tax brackets where it's 38% if you go over $180,000. So you go to work tomorrow, let's say you're lucky enough to be in that position that you're making $170,000, and your boss says to you, I'm going to give you a $30,000 pay rise next year. And you go, no, I'll only want 10 or 9,500 because I don't want to go into that next tax bracket. You'd never say that. You'd go, thank you very much. I'll take the extra 30 grand and I'll pay tax on that extra bit. So yeah, I just think, be careful who you're listening to and do your own due diligence on all parties and think about it properly in the real context, because once it's in, it'll be full blown, I would say within 12 months. And for that to happen, as I say, I'm not against it, but for that to happen, GST should be changed in New Zealand.
Yeah. And I think, in reality, we need to accept the fact that at some stage, it's a high probability that we will get a capital gains tax. So, just like every other tax change that we've seen over the last quarter of a century, we just roll with it and work out how to work within the new rules. And this is where having a really good accountant helps.
Next topic.
Yes, the economic shift, jobs and interest rates. So let's move to the economy. The latest inflation data has caused a significant U-turn in market sentiment.
So some people were hoping that interest rates would continue to fall through 2026, even though most economists were saying we're near or at the bottom of the interest rate cycle anyway. So the latest CPI, the Consumer Price Index, data has potentially thrown a bit of a spanner in the works there.
So let's have a look, deep dive. The breached band, annual inflation for 2025 hit 3.1%, which is officially outside the Reserve Bank's 1 to 3% target band for inflation. And the quarterly result was higher than everyone's expectations, Reserve Bank included. ANZ and BNZ have already moved their forecasts forward. They're now predicting that the first official cash rate, the OCR, they're predicting the first OCR hike could happen as early as December 2026. Some are saying potentially even earlier than that, like potentially around October. While global prices are easing, domestic costs like electricity, which has increased by 12.2%, and council rates are keeping inflation higher for longer. But what you need to remember is that the Reserve Bank reacts to inflation as well as how the economy is performing. Inflation might be higher than expected, but that doesn't mean that people are going to be going on a spending spree, pushing inflation even higher. The official cash rate is only going to be increased if the Reserve Bank wants to reduce the risk of further inflation. And historically, they've always moved later rather than sooner. So, most people, including the Reserve Bank, are expecting inflation. And when I say most people, I mean most economists, including the Reserve Bank, are expecting inflation to settle down again soon, which is a good thing. So don't panic.
And another thing to note, the RBA, so the Reserve Bank in Australia, has today changed their official cash rate for the first time going up. So it's been stagnant at 3.6%. It's gone up 0.25 basis points. And the reason being is the RBA didn't take the official cash rate so low. So they, rather than having a bit of a downturn like New Zealand's had, they have just sort of scooted along and carried on. And it's been quite productive, but the actual means of growth in the economy is only 2%. So they're not putting up much because they don't want to stall the economy. They want productive parts of the economy to keep going, but they don't want things to get out of hand on the inflation side of things. So I think inflation was 3.7. So it's again outside their band.
Australia.
Yeah.
Yeah. So, in a nutshell, at the moment, the official cash rate in New Zealand is at what is considered to be, it's not inflationary and it's not stimulatory. So it's at a neutral level. So I think that the latest results on inflation have reduced the chance that we're going to get another reduction, because that would push us into stimulatory territory. So it's reduced the risk of further reductions, but it doesn't mean that we're going to be facing increases in the next few announcements.
Yeah. So if you do have a few mortgages, have a chat with your mortgage broker. We do always suggest using a mortgage broker rather than straight to the bank, because they get paid a commission, but also so does the person at the bank get paid a wage. But they love repeat business. So they're there to make sure you're getting the best bang for your buck. You're going with the bank that's got the best rate or the best cashback deal at the right time for you personally. So that makes a real difference. So
yeah, I often say to people, if you go directly to the bank, you're talking to an employee of the bank. Whereas if you're talking to a mortgage advisor, they are working for you. They're not working for the bank. They've got access to a range of different lenders. So definitely have a chat to your mortgage advisor. You might want to consider splitting your loan across different expiry dates. So, maybe fix part of it for 12 months, just in case we do get low interest rates for longer. And you might split the rest of it for maybe 3 years. Obviously, there's a few other things that need to be taken into account, though. So make sure you talk to your mortgage advisor. Just remember, interest rates are still pretty attractive. Like, they're still pretty low. And bank lending rules are pretty friendly at the moment as well. So there's also plenty of opportunities around, like lots of properties available to buy. Sounds like a good time to go house hunting if it was me.
Absolutely. So another topic that we have seen as a bit of a pressing issue this year already is the sort of climate resilience that we have.
Yeah, so this is a little bit more about, maybe some extra things that you should do during your due diligence when you're looking at properties to purchase. For decades, New Zealanders have focused on earthquakes, because we live basically on one big fat fault line. But now the conversation's shifted to include weather events as well.
The scale, around 70,000 homes in New Zealand currently sit at high risk for flooding or coastal erosion. There is a bit of an insurance retreat. We're seeing insurances in real time, about 1,000 houses now effectively uninsurable, and premiums for higher risk zones have doubled in some areas.
The government's releasing the first national climate change risk assessment in April this year, which will likely change how banks view lending on coastal properties.
Yeah. But what you need to remember is don't freak out. Remember, if you are in an area where you've been zoned for flood risk or coastal erosion, doesn't mean that insurance companies are going to pull your cover. It might mean that you might not be able to switch insurance companies as easy. It also means that if you sell your house, it doesn't mean the next purchaser isn't going to be able to get insurance cover either. They might just be limited to the current insurer.
We've also noticed that some areas have been zoned for flood risk, whereas the house hasn't flooded at all in any of the recent weather events, even though the neighbours or near neighbours might have, and they're not zoned for flood risk. So I think a good summary is that the flood maps are an indication of flood risk. They're not the be all and end all. Okay.
Yeah.
So do your homework on every property that you purchase. Do your research to see if there's been a history of flooding or anything like that, and make the decision that you feel comfortable with.
Yeah. And it's, if you are looking at a property, it is relatively easy to find from the insurance company whether or not they've made a claim. So that will tell a lot of stories. So that wraps up this episode, number 2 of the one we're doing together.
And if you're listening to this and feeling like you need to stress test your strategy for 2026, we'd love to see you at our next free online event.
And that is called the How to Succeed with Property Investing. And we go through the fundamentals of property investing, and that has not changed. So as long as you've got your numbers right, you're all good.
So register at propertyapprentice.co.nz.
Thanks for tuning in, everybody, and look forward to seeing you next time.
Let us know in the comments what your thoughts are about these episodes, and if there's anything that you want to hear us talk about in particular in one of our future podcasts, just type into the comments below. Thanks.
Thanks.
Hey there. Want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.